Hey everyone, it's Ed Zoller, Villa Realty Group with your end of November 2025 market update for Lee County. And honestly, the trends this month are getting harder and harder to ignore. You got inventory rising, but what's really shocking is a word that I haven't said in almost 2 decades. Foreclosures. Activity is accelerating so fast that our area now ranks number 7 in the entire nation for year-over-year foreclosure growth. Newest data shows 1 in 3 expired listings come back on the market. This is a constant wave of supply that really never lets up. Builder inventory is now so high that many builders are cutting deep into their margins just to move homes, even if it's at a loss. Put all that together, and it's no wonder buyers are stepping back and why the resale market feels like it's right on the edge of a major shift. Let's dig into what all this means. First, we always start with supply. A couple things to note on this. Supply always peaks at the exact same month, and it always valleys at the exact same month. And you can see here, September, 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 where the arrow is, September right here. We're going back on this normal cycle. We have a season. The inventory grows, and then season gobbles it all back up. You can see here it swings about 3,000 homes at every single peak and interval. Over this big mess here was what happened with COVID, where we just didn't have any inventory at all because many people pulled themselves from the market, left the market because they were afraid of COVID. And then here we go again, way back up. At one point this year, peaking out at 14,000 homes. But here's the thing that concerns me. These bottoms here, right around 8,000, 7,700 or so. This bottom here was 10,000. If this goes all the way back up to 14,000, this is what I'm talking about, this inventory growth. Inventory went up 5%. That's the second consecutive month. Now, we expected this because it's always happened in history. But what I did not expect is that the amount of homes that we are getting on a consistent basis, instead of it kind of gradually working its way back up. We are gaining at this level right now, these 500-600 homes a month. Expect this for the next 6 months. Our year-over-year inventory is 3% higher than it was November of last year. And of all these inventory that we gained, we still have the same ratio. 65% are single-family homes, 22% are condos, the rest are townhomes and villas. But what was shocking as well is the builder inventory increased 2%. All these deals, all these interest rate incentives, all these closing costs that you're seeing me promote, as well as me telling people this is the kind of incentives you can get, $90,000, $100,000 incentives, they are still gaining inventory. This is the same solution they had back in 2006 and 7 of, okay, the market's turning, let's build more. And they're still building more. But what are they supposed to do? Especially the nationals. They have to build or they go out of business. Our builders are going to start panicking with this. There's a couple more to this graph, though. I dived in a little deeper about the expireds, terminateds, and withdrawns. And as you can see, I've been trying to track this since 2020. Here's our long-term average, hovering around 600 to 700 or so. And you can see here, yes, our expireds and withdrawns have come back on. But there's something to consider with this. I saw recent data that says that 1 out of 3 expired listings come back on the market. 1,349 divided by 3, let's see here, I'm doing a quick graph, I didn't even think of this until now. That's another 440 homes coming back on the market that we're trying, but this is kind of like people giving up. Sellers are giving up. 156 of these were new constructions, but only 14 were national builders. And why would a builder do that? Why would a builder give up when they know they have to sell the home? Heck, 8 of these were from Lennar. But I have an idea, and some of them from holiday builders. Well, the holiday ones actually expired normally. 365 days, they still can't sell it. Expect those to all come back on the market. But Lennar will sell a home at such a big discount that they do not want to have that show on the MLS so that it's readily available for people to see. Let's say they're trying to sell a home for $350 and sell it for $280. They do not want that on MLS, and so they tend to pull them from the market so they can do that sale behind the scenes, and then eventually it gets recorded on the county website, but you don't really see that on Zillow, Redfin, and for the public to see as well. But, having 1,300 homes is good leaving the market because it's what our market needs. We need these overpriced, upside-down, unrealistic sellers off the market. But if they're truly upside down and overpriced and they fall into ruin, these will be coming back on the market again. We're going to go over that a little bit. This is a graph from last month that just shows how low our demand is. And this stat comes from National Association of Realtors. So it doesn't matter where in the country, because this is a national stat right here. You can see here that we have not been this low in 2025 since 2009 as far as how much demand is out there. So let's just take that for the grain of salt for the next graph, where This is talking about those expireds. Sellers are pulling the homes off the market at the highest rate since 2016. Contract signings are at their lowest level, and obviously this is going to make sellers want to quit the market. And as a result, this delisting jumped 28% year over year. Sellers are pulling their homes from the market rather than try to compete with this market. The top cities being Washington, D.C., many parts of Dallas and Texas, Austin talking to you, Punta Gorda, obviously our area, Fort Myers as well. And Florida is topping in the rankings of that. The problem is it doesn't get better for sellers out there. With this new data coming out about foreclosure filings, sellers are pulling off the market at the highest rate. But according to Adam, the 1 in 5 delisted homes are just going to come right back on the market in 3 months. And so just consider that when we're talking about inventory and these expired listings. Just because they expired, terminated, or withdrawn does not mean they're not going to come back on the market. They're not sold. They didn't disappear. They are going to be future inventory, which could cause our inventory to skyrocket more than we expect. Let's go back to demand. So demand graph, and this is for those of you who haven't seen my updates before. I always go to supply, demand, try to break it down. But something about this trend analysis tells me the same thing that told me with the inventory. We have a season. We hit a peak in March, April. But I circled the highs because you can see it's all lower highs going all the way back down, following this channel. And the lows all continuously lower lows. And this, in January of 2025, that was a 40-year low. And every month that we've hit, February, March, April, May, June, July, August, all of those have been the lowest of that month in 40 years. But we did have a positive thing where we actually broke that trend last month. And the month of November, this was not the worst one in 40 years. Now, it was the worst one since 2008. So maybe going back, 18 years, but at least it wasn't a 40-year low again. That's a good trend to break. What I'm really looking for with this graph is it to break this channel. As you can see here, just looking at trends, it peaks in the same month, it messes around and hits a low right when it's always hit its low, just as we did every single year. The peak, it kind of messes around, then hits a low. Peak, messes around, low, peak, messes around, low, peak, messes around, and continue. And we should probably hit another low. God help us if we only sell 600-700 homes. So I really don't think it's going to get that low, but I've never thought it would get as low as it's done every single year. So it can happen, of course. Interest rates did go down from when I wrote this last month to 6.38 down to 6.22. That's a good step in the right direction. Positive there. Of these 938 sales that we did in November, remember our average is 1,700 homes a month. But of those, 248 were new construction. That is down 14% from last month. So that's got to be concerning to builders out there that they're only now 1 out of 4 are buying their homes, not 1 out of 3. And they're actually losing the buyer demand, which tells me buyers are starting to go after possibly used homes and not their products. The median home price actually went up again, but I kind of drew a line. The problem is look at the steepness of this. We corrected. It didn't feel at the time from the peak of 2005-06, and it's crashing down to 2011 at our low, 5 years. But we dropped pretty fast underneath this trend line. This is going really slow. This is being really super stubborn. The median home price is because you have such low sales. And you have these $1 million homes that sell out there. Obviously, that skews this graph. We had 54 homes that sold over $1 million, and one sold for $9.7 million on 5,200 square footer on the Gulf of Mexico at Bonita Beach. That does skew this graph, but if I'm consistent with this graph, we should be able to look at it more for trends and not saying that any house under $375 should be the best house, should be great, great deal. It's not. Of the new constructions, 248 of those new constructions, the median price is only $350. And that's 1/4 of our sales. So you can see here, this kind of gets skewed a little bit. So you don't look at it for what it is as a median home price graph, but you are trying to look for a trend, and I'm really trying to have this break and support off this line to show that we're going to increase in price. But right now, with all the data I'm looking at, I'm not very bullish on the real estate market due to all the data I'm looking at, showing you that it's probably going to be still in mood for a correction, and it's probably going to happen the whole rest of this year and into next year. One of the main reasons is affordability. As you can see up here, there is no reason why anyone should afford 52% of their gross income going to a mortgage. It's not sustainable. It's not a market that's affordable at all. And what happens last time it did that in 2006, it crashed and came all the way down into this, I call this the golden zone. And where are we at right now? Now the little 30.30 was from last month, but this month it was 31.67. It got further away from where we actually want prices to go. But I'm not just talking about prices. I'm talking about affordability, principal, interest, taxes, insurance. We can calculate what the mortgages should be. An $85,000 household, that's the average household income. Congratulations, Lee County. You've made another $100-something bucks a year in income. That increased. That means that if we just go to this trend line, this average, which actually takes into account these two big bubbles, the mortgages should be $1,900, but they're not. They're like $2,600 a month. And if they go actually down to my box, they should be more like $1,600 a month. A teacher making $50,000 a year should probably not give up more than, definitely don't want to give $2,000 a month of that towards a mortgage. $1,629 is where I think this market is going to be going, unless, we need some help from insurance and taxes and everything else. But right now, the average home with current rates and everything else is $2,200. And as you can see here, until this corrects itself and gets back down to what this, in my opinion, the target zone box. If people say, are we a sustained market? No. Are we bottomed out? No. It's still going to keep correcting until it does. Home value growth. This is the Zillow Home Value Index. Zillow is great for data. Maybe they really suck at guessing what your house is worth, but they are good of data itself because they collect it nationwide. And what I did is I looked at Lee County's Zillow Home Value Index. And what you can do when you graph this all the way back from 2000 is you can look for the trends. And you can see when we bubbled, you can see here that the houses were going up over 3% a month. That's 36% a year at that rate. Obviously, it could not be stable at that. So then it crashed and it went almost in the opposite direction where we were losing 3% a month. And then what it do? Kind of got back to stable, went back down, kind of didn't show support, kind of found resistance at stabilization. But in 2012, our market finally stabilized. And then it started going back to a normal, what this graph looks like over here is exactly what this one did here. When 2018, when they just tried to increase the interest rates to see and test to see what that did, it kind of crashed us a little bit. But then obviously interest rates boomed and then FOMO started happening and we again bubbled. It went straight up to almost 3, double hit. This time it was only 1 month it did it. This time it hit it twice where we're hitting 3% a month appreciation on a house. Not sustainable, not stabilized. What did we do? Quickly came back down, tried to make a little run when interest rates tried to take a little hit, and now we are completely underneath that zero line. It is starting to make its way back up. And as you can see, when I've tracked this, it took 59 consecutive months for us to stabilize. We were at 28 consecutive months, but I did hit every single negative that we were. And you can see about 3 months ago, negative 1.28% a month was the worst that our houses were losing. That was 3 months ago. And it is starting to climb back up. So that's a positive thing, but it did it last time here. It went up, then it went down, then it went up, then it went down, and here it kind of just messed around. It kept going up and down and up and down. And I would like to think that this is going to happen right in this range. I'd hate to think that home values lose 3% and we go right back down to this direction again. But from what this is, if someone asks me, are we stable? No, because it's under that line. And are we affordable? No, because it's above that blue box. Home value growth year over year, and I go back all the way down to 1970, and I did look back even further to the 1950s. Right now in the country, this is not just a local problem. This is a country problem. When I looked up the year over year Zillow Home Value Index for the country, it is currently at 0.1. Now, this is recession era levels because look, the last time it ever got down under 1, what happened? Well, here, this graph went down to 0 during the 2022 rate shock when we went from 2-3% interest rates to 6-7. That caused a major issue with home prices. We had obviously the big bubble crash of 2008. Before that, it got down there during the 1990 Gulf War, which this great box here is a recession. And then the 18% mortgage years of 1981, the double dip recession they talked about when this hit back down under 0 or under 1%. And then now, what are we going to call now? We have names for all of these things. We don't know what now is. Now is going to be called what? So this is not just a local thing. This is a country thing. And you're starting to see it happen now in New York City, California, Georgia, Kentucky, West Virginia, Pennsylvania. You guys aren't immune to this. You may not have seen it in the last 12 months like we've seen it here or like in Texas, but other states are starting to follow. Especially in Pennsylvania and many parts, especially the southern part of Georgia or Atlanta, where you're seeing anywhere from some areas losing 15 to 20% year over year. So just something to consider, just putting all of this together. Our stats month to month is our inventory obviously went up 5%. Now we've hit over 11,000 homes for sale. Our solds did go up. That's a positive thing. Sales went up 5%, but they're still half that of our normal average. The pending sales went up. Now, pending sales tells you how many sales you're going to have next month. So when these 1,300 pending sales equaled 900 homes, what are 1,400 pending sales going to be? Well, we should see an increase next month. And if we don't, that means a lot of them probably fell apart. The new constructions was the big shock for me. The previous month it had gone down, and it just popped back up. All these incentives are offering, all these discounts, all these drops in prices, and builders gained more inventory in Lee County than we had the previous month, up 2%. Average time on market, we actually were number 6 in the country for days on market at 101. Thank God we're under that 100 mark, but just understand that 95 days is a long time for houses to sit on the average on the market. Our asking price went up, our selling prices went up. But again, guys, this is all because we have such low sales and we got $9 million homes selling that kind of skews those median prices. But something I do know of note, the asking price is sold very well close to full price. If you have a used home and you're trying to sell it, you need to price yourself accordingly and you will get that price. You do not have to think, I'll just start bringing offers. You have to drop yourself to a price to entice a buyer to even make an offer on that. So that's kind of the stats month over month. You can feel free to read my description, the summary. I have a couple new charts I wanted to go over talking about these builders and these panic builders out there. Lennar has their SEC filing, and they talked about since 2012. And there's something of note on here. During pandemic peak, 2022, Lennar, on the average in the country, it's the second biggest builder in the country, we're making $491,000 net on each of their houses, on the average. Obviously, some high, some low, depending on area. That's the most they've ever seen in the last decade or so. That was also during the time when it was highest and best, multiple offers, no incentives. You better give us 70 grand more than asking price, or we're not even going to consider your offer. That's back in FOMO buying was happening, especially by Lennar, because I didn't sell Lennar for like 2 years because that was a bunch of garbage. And as you can see here, they have continuously dropped all the way down to 383. Negative 22% decline in sales price. And what's funny to me is they're advertising right now is the best time to buy a home. Is it? Do you think so? They also said that back in 2024. They also said that back in 2022. Here's this. If you bought in 2019, the average Lennar house at 421, was that the best time to buy? Now you got a older house and people are buying houses cheaper than that. So when was it the right time, since 383 is the lowest since 2018? So majority of these losses come from their interest rate buy downs, making their homes affordable. They're still trying to command that higher price, and this trick does tend to work. Let's get your monthly payment way down. As long as you're in the house for about 10 years, there's no problems with that. Problem is most people don't buy a home and think about 10 years from now. They think about the 2 to 3 years. And then what they're going to end up doing is get stuck. Because if they bought 2-3 years ago from right now, they'd be sitting at 414, 428, and Lennar's selling that same home for 383 brand new. Think about that. Fred, also, the latest numbers came out just about a couple days before I wrote this, and this is the builder inventory again. And look at that sharp drop. I mean, that's a good positive thing. Are builders running out, though? No, because even with that sharp drop, 295,000 homes in the South under construction, new homes to be sold, is still higher than they had in the peak of our last bubble, which a lot of people say that was the cause of our bubble. Garbage loans, and builders built way too many homes. And here we are. So are builders still going to be panicked probably for the next 12 to 24 months? Probably. And so this kind of backs that up. And then the latest data point I talked about in the beginning, and I really didn't want to say this word ever again. I lived through that crisis. It really sucked. But we have seen now, I'm starting to track the data. Once I saw that national data come out, I did track Lee County, and we do have right now 84 short sales. A short sale is where the owner owes more than what they would make if they sold the home. And if they can't afford to cut the check, $10, $20, $50, $100,000 check to sell their home, and yes, that does happen, they ask the bank to eat the difference. And they try to do what's called a short sale. To even begin a short sale, they have to stop paying that mortgage. The bank won't even talk to them unless they do that in most cases. So then they stop paying their mortgage. They're delinquent. The bank says, what can we do? They'll maybe offer a deed in lieu of foreclosure, or most of them will say, let's try a short sale. And so these short sales are a thing where the house is fine. It's not the house's fault. It's just that the owners are upside down. Then a short sale that fails ends up becoming a foreclosure. That's when the bank takes it over. And we have seen some significant increases in the foreclosures that banks have of inventory. Right now we have 53 of them, but last year we had 8. So we're seeing an increase of this thing. And then, of course, future short sales to foreclosure process. Before it becomes a short sale, they have to, remember, stop paying their mortgage. When they stop paying that, a Lis Penden gets filed. Now, Lis Penden is like a lien on the property. An HOA can put a Lis Penden on your property for lack of payment. Mortgages, obviously, banks can do that as well. So I can track, thanks to Lee Clerk of Courts, Lis Penden data, and I have seen since the beginning of the year, and I'm going to probably take this further back too to show you what was happening during COVID, because obviously we had a foreclosure moratorium, so Lis Pendens weren't being filed, but you can see this rapid increase up. That right now we have, I think, 2,200 Lis Pendens that were filed alone this year in Lee County. And so for those of you that were around back then, this is probably not a word you want to hear, but what this is going to do is this is 37 homes that we have in inventory that we wouldn't have had if there wasn't this kind of duress out there. And if that keeps ticking up, that's another form of inventory that's going to flood our market. The foreclosure data I did want to pull up and see if Cape Coral Fort Myers ever even ranked in that. And they always put Cape Coral in there, and that is Cape Coral Fort Myers. So don't think just, oh, Cape Coral sucks and Fort Myers is great. This is Lee County. This is all 5 cities in Lee County. But this is not just a local problem. Mortgage Monitor has a little report that comes out every single month that you guys can find out there. And Cape Coral Fort Myers had an increase in foreclosure filings of 57% right there. This is the highest year-over-year change with Houston, Texas, Colorado Springs, Denver, Colorado, Provo, Utah, Detroit, Michigan, Augusta, Georgia, and Cape Coral Fort Myers sitting right there in the top 10. You obviously get parts of Texas, Tampa, Deltona. It looks like Florida, Texas kind of leading the league on this thing. Hey, kudos to people out there in Buffalo who have the lowest year change over change. The lowest foreclosure rate is actually, I think I saw Rochester, New York, my old town in there somewhere. Oh yeah, Rochester, lowest year over year change. No foreclosures happening there as much, but this, I thought that was interesting that we have our name appear yet again on a top 10 list of something in the country, and this is not something you want to be a top 10 in. But it's just showing you it's coming. With Lis Pendens are picking up, the short sales are starting picking up, the foreclosures start picking up, and we're going to monitor and track this so you guys can stay informed. This month's deal, all this doom and gloom, and what on earth, why on earth would anyone buy this? 4 or 5 days ago, that my person had been looking for a home. It didn't intrigue me until they told me they were cutting $40,000 off their base price. So $359,900 is what it was when they tried selling it. It never sold. So then they dropped it down $40,000 and got down to $319,999. So then I thought, geez, buyers are slow and builders are panicked, and what can we do to make this deal great for my buyer? And he had a certain monthly payment in mind. In order to get to that, I had to get the incentives from that builder, $95,000 of incentives. And here's how I broke it down. First, the $40,000 off the price they already did. Asked for another $5,000 on top of that. Asked for the 3.99 fixed 30-year loan, which has cost 9 points, $28,000 if you try to make that yourself. I asked for a full 6% concessions to closing costs, or $18,899, but also asked for additional three to four grand. And with that 3 to 4 grand, see, you can't give it to the buyer. It can't be in form of cash. It has to be an incentive. But we've already got all the incentives. So what do? You do a 2-1 buy down, a 1-1 buy down, or a 3-2-1 buy down. And what that means is, for the first year, the interest rate's 1.99. On the second year, it's 2.99. This is a 2-1 buy down. And on the third year, for the rest of the remaining life of the loan, all 30 years, it's 3.99. That does save you about $178 a month. So that first year, you're actually not giving the bank $4,200. The following year, you're not giving them about $2,100. That's $6,400 and a nice way of giving you cash back for the house. Total incentives, $95,000, making that monthly payment, principal, interest, tax insurance, and HOA at $2,180. Let's take the same home in the same community. Also, this is Coral Bay, this is Coral Bay. This is 1828, this is 1828. This is only 1 year old, but this is owned by a person. They have on the market right now for $329,900. Let's see what we can do to make this that same deal. Let's say he did give us 19 grand in closing costs, and we zero those closing costs out, and we have money left over to buy down the rate from 5.875 down to, let's say, 5.5. That monthly payment would be $2,641 with the same money down. So my person can save $461 a month, not counting the 2 years that they're saving even more than that, or about $5,500 a year. And to make this same home, this used home, this 1-year-old home, the same monthly payment as this brand new same home, just flip-flop garage, you'd have to drop the price 22%, or 75 grand, down to like $250 to make this payment the same. Do you see the pressure the used market has and what sellers have to face out there? That's just another thing to take in consideration. But deals can be had, but you got to be patient. 1 month ago, this was not the deal you could get on this home, but many people took it. This was the last 2 homes that they wanted to just fly out, and when you hit them at the right time, end of the month, right before their fiscal year or their end of the quarter or end of a month thing, you catch them at their meeting. Those are Fridays, by the way, and you hit them up at that time. So let's do an overview real quick. I've already kind of described. You guys can always pause and read this. Pending sales increase, that's good. Sales increase, that's good. Inventory went up, that's not so good. Affordability got a little worse, that's not so good. Stability is getting closer to zero, so that's good. Still losing 0.7% a month, so that's a fine. New construction, though, that is really showing its ugly head right now, that they're gaining inventory. They still have to pretty much sell their houses at a loss, if not break even to move them. And even with those incentives, they still can't sell enough. And then the record-breaking still, even though it's down, and that's a positive thing, eventually I do foresee that graph hitting down where builder construction in the South will hit to normal levels. And then you'll know that builders don't have the major crazy incentives, and that's when the used marketplace catch up. Advice for buyers, I'm just going to keep saying it until I'm blue in the face, and I'm going to misspell the word because I say it too often. Patience, 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 patience. You wait for your deal. Buyers need to find out, you need to find out what you want. Narrow down your search. Strike when the sellers / builders are at their most opportune time, and just don't reach for those daggers. Don't say, this is the best I'm going to get, because you're probably going to get something better. Pick your payment. Let the builder come to you. All right. Wait for your deal. Do not settle. We got 11,000 plus homes of inventory. So you are in control, Mr. and Mrs. Buyer out there. And do not jump over fences, and don't be led on by, this is the best year to buy a home. This is the best month to buy a home. Hey, and the news said it. Just do it at your own pace and go when you're ready. You will know when you found the perfect home. And you will know when you're in that house that you're going to be in for the next 7 to 10 years. And at that point, it's not going to matter if you get the smoking hot deal or you're within 10% of the bottom, because you love your home. You love the home now. You're going to love the home for 7 to 10 years. If it's an okay home or a meh house, I wouldn't even touch it with a 10-foot pole. And advice for sellers out there, obviously, if you bought prior to COVID, you still have fake equity cash on too. But if you bought after 2020, it all depends what you bought and kind of almost the month you bought it in. If you bought 2022 or 2024, then you're most certainly upside down unless you put enough money down. And short sales are working if done correctly. Most short sales don't succeed. That's why the foreclosure filings are up. This is why we're going to see 58 foreclosures out there, those that even try to do a short sale. Sellers don't understand it. They understand that you can get out from this house if you made a mistake and bought during those COVID years, those 2022, 2024 COVID years, and you're upside down on it and you got to go and you can't afford the home and the increased insurances and the increased costs. There is solutions. You can always give me a call. And I don't care what city and state you are. Short sales are short sales are short sales. I can at least give you some guidance with that. And then sellers out there who do have equity and they do want to sell, get a pre-inspection on your home. Buyers are super picky. You got to give them a perfect home. You can't make them guess. And so I've had success selling almost every one of my listings in this horrendous market by having it being the only one that offers up the incentives and offers up some buy down and gives them a home warranty and gives them a pre-inspected move-in certified home. And you just price yourself accordingly. You will get your full price. The last 3 listings I sold this month, we all got our full price. We had to give them stuff, but we did get the full price on it, but we did price ourselves according to the market. Again, what all my data comes from. And guys, if you have any questions, please feel free. This is my phone number for my cell, my email, and my websites to go to. I hope you all have a great one, and I look forward to speaking all again next month. Talk to you later. Bye-bye.